All right, we're back with another lesson. Okay, so this is going to be a relatively long PowerPoint. So I'm breaking this up into two sections, but we're going to go over moving averages and what they are. Okay, moving averages are one of the most commonly used technical indicators. A moving average is a simple way to smooth out price fluctuations to help you distinguish between typical market noise and the actual trend direction. You are taking the average closing price of a currency pair for the last maybe 5, 1 hour, or whatever number of periods. The moving average looks like a squiggly line overlaid on top of the price action, represented by Japanese candlesticks. This type of technical indicator is called a chart overlay. The moving average, or other abbreviations, MA, is overlaid on the price chart. Just like every technical indicator, a moving average indicator is used to help us forecast future prices. The reason for using a moving average instead of just looking at the price is due to the fact that in the world of Forex, trends do not move in straight lines. Price tends to move sporadically, so a moving average helps smooth out the random price movements and helps you see the underlying trend. By looking at the slope of the moving average, you can better determine the trend direction. There are different types of moving averages, and each of them has its own level of smoothness. The smoother the moving average, the slower it is to react to the price movement. The choppier the moving average, the quicker it is to react to the price movement. So to make a moving average smoother, you should get the average closing prices over a longer time period. How to choose the proper length of a moving average. The length or the number of reporting periods included in the moving average calculation affects how the moving average is displayed on a price chart. The shorter its length, the fewer the data points that are included in the moving average calculation, which means the closer the moving average will stay to the current price. This reduces its usefulness and may offer less insight into the overall trend than the current price itself. The longer its length, the more data points that are included in the moving average calculation, which means the less any single price can affect the overall average. If there are too many data points, price fluctuations may become too smooth, so that you won't be able to detect any kind of trend. Either situation can make it difficult to recognize if the price direction may change in the near future. So it's important to select the length or periods that provides the price details appropriate for your trading time frame. The 4-hour, the 1 hour, 30-minute, 15-minute, the 5-minute, etc. There are two major types of moving averages, the simple moving average and the exponential moving average. Simple moving average, SMA, explained. A simple moving average, or in other abbreviations, SMA, is the simplest type of moving average. It calculates the average price over a specified period, typically using closing prices. A simple moving average is calculated by adding up the last X amount of whatever period's closing prices and then dividing that number by X. The moving aspect comes from the fact that as each new data point, such as a daily closing price, becomes available, the oldest data point is dropped from the calculation, and the average is recalculated, creating a line that moves along with the price chart. Calculating the simple moving average, SMA. If you plotted a 5-period simple moving average on a 1-hour chart, you would add up the closing prices for the last 5 hours and then divide that number by 5. Then you'll have the average closing price over the last 5 hours. String those average prices together and you get a moving average. If you were to plot a 5-period simple moving average on a 30-minute chart, you would add up the closing prices of the last 150 minutes and then divide that number by 5. This is important to understand so that you know how to edit and tweak the indicator. Understanding how an indicator works means you can adjust and create different strategies as the market environment changes. As with almost any other Forex indicator out there, moving averages operate with a delay. Because you are taking the averages of past price history, you are only seeing the general path of the recent past and the general direction of future short-term price action. Here's an example of how moving averages smooth out the price action. On the chart above, we plotted 3 different SMAs on the 1-hour chart of USD CHF. As you can see, the longer the SMA period is, the more it lags behind the price. Also, notice how the 62 SMA is farther away from the current price than the 30 and 5 SMAs. This is because the 62 SMA adds up the closing prices of the last 62 periods and divides them by 62. The longer period you use for the SMA, the slower it is to react to the price movement. The SMAs in the chart show you the overall sentiment of the market at this point in time. So with this, we can see that the pair is trending. Instead of just looking at the current price of the market, the moving averages give us a broader view, and we can now gauge the general direction of its future price. With the use of SMAs, we can tell whether a price is trending up, trending down, or just ranging. There is one problem with the simple moving average. They are susceptible to spikes. This can give us false signals. We might think that a new trend may be developing, but in reality, nothing has changed. Exponential moving average, EMA, explained. An exponential moving average, or in other abbreviations, EMA, is a type of moving average that gives greater weight to the most recent price data, making it more responsive to new information compared to the simple moving average, SMA, which weighs all data points equally. Here's an example. Let's say we plot a 5-period SMA on the daily chart of Euro USD. The closing prices for the last 5 days are as follows. Well, what if there was a news report on day 2 that caused the euro to drop across the board? This causes Euro USD to plunge and close at 1.3000. Let's see what effect this would have on the 5-period SMA. The example and the numbers are down below. The result of the simple moving average would be a lot lower, and it would give you the notation that the price was actually going down when in reality day 2 was just a one-time event caused by an economic report. The point that's trying to be made here is that sometimes the simple moving average might be too simple. The exponential moving average filters out these spikes so that you won't get the wrong idea. Exponential moving averages give more weight to the most recent periods. In the previous example, the EMA will put more weight on the prices of the most recent days, which would be days 3, 4, and 5. The EMA calculation assigns greater weight to the most recent prices, while the influence of older prices, including any large spikes, is reduced exponentially as time passes. This means that the spike on day 2, its impact on the current EMA value is minimal, allowing the EMA to reflect current market conditions more accurately and respond more quickly to recent price changes. In contrast, the SMA gives equal weight to all prices in the selected period, so a large price spike from the past continues to influence the average until it drops out of the calculation window. This makes the SMA slower to adjust to recent changes and more susceptible to being skewed by older price movements. As a result, the EMA is generally more effective at minimizing the lingering effect of past price spikes and providing a more current view of price trends. Exponential moving average versus simple moving average. Take a look at the 4-hour chart of USD JPY to highlight how a simple moving average and an exponential moving average will look side by side on a chart. Notice how the red line, the 30 EMA, seems to be closer to price than the blue line, the 30 SMA. This means that it more accurately represents recent price action. You can probably guess why this happens. It's because the exponential moving average places more emphasis on what has been happening lately. When trading, it is far more important to see what traders are doing now rather than what they were doing last week or last month.